Welcome to Trade Like Champion. Today, I'm revealing the secrets behind the Volatility Fabric Indicator, an advanced market tool directly from Kirk Northington's book, Volatility-Based Technical Analysis, Strategies for Trading the Invisible. Get ready to master volatility like the pros and learn how to spot hidden structures that institutions use, so you can trade with the insight of a true champion. Consider the blank chart with only candlesticks representing price movement. To a technical analyst, it is a beautiful sight. Within it is complete freedom to see all the important volatility-based measurements that matter most. A blank chart begins to give you the ability to think and see price movement differently. This is exactly what you need to do. So far we have focused most of our volatility measures on indicator development. It is important to be able to look at a price chart without the aid of indicators and feel something. The best traders can do this. It often presents as the ability to look at a price point and feel that a point of inefficiency has been reached. This ability to visually comprehend is not innate to humans like it is to sandpipers. We have to work at it. We will use here on-screen indicators that are displayed in the price plot area, just like we did with linear regression lines. Think of the price chart as a piece of cloth. Clothes are made of fabric. All sorts of threads can be stitched and woven into the fabric. We will refer to it herein as volatility fabric. A volatility fabric is a continuous series of volatility-based mathematical relationships shown as a backdrop to the price chart itself. Chart fabrics are not new. They have been presented in years past as many types of indicators, such as moving average ribbons. We will start with a fabric composed of standard deviations. To display a standard deviation fabric, we will create it as an indicator. A standard deviation is built around a mean. The TTI fabric SD indicator will begin with a 40-period exponential moving average to maintain consistency with our previous work. Quantities of standard deviation are then added to, and subtracted from, the moving average to create the fabric. The darker central line is the 40-period exponential moving average. Each line successively moving away from the central moving average represents one additional standard deviation. The standard deviation lines are colored a light gray so that they present more of a backdrop, and avoid interfering with the primary trading signals that will ultimately be displayed. Study this chart for a moment. You may be wondering what the point is to this. A fabric is not meant to be a primary indicator, or to generate buy or sell signals. Its purpose is to train your mind. With it consistently on the background of stock charts, your eyes begin to see price movement in a different way. The lines themselves show your eyes the distance price has traveled in units of that particular stock's standard deviation, in lieu of dollars or percentages. Your brain will begin to recognize movement by volatility measurement standards. Relativity is added to price movements that might not be seen otherwise. In reality, it was a return to the central tendency of its trading range as measured by standard deviations. Yes, it did trade downward, but relative to its trading range, it did not do so. The fabric gives us a more important basis for normalizing price movement. It's important to point out that the example of volatility fabric is actually a form of Bollinger Bands. The most basic form of a Bollinger Band is a measure of standard deviation around a simple moving average. You will most commonly see them presented as a 20-period simple moving average, with upper and lower band lines that have default values of 2 standard deviations. Even though our example uses an exponential moving average, it is the basic construct of Bollinger Bands. John Bollinger created them and permanently changed the way the markets looked at short-term volatility. Many traders use Bollinger Bands without truly understanding how they are calculated. You should have an inherent advantage because the previous chapters presented the basic mathematical mechanics of this legendary volatility measurement tool. Have you ever noticed how life seems to travel at different speeds? Sometimes things are normal, sometimes they are boring, and occasionally life is like getting shot out of a cannon. The saying "when it rains it pours" must originate from the times when daily routines suddenly cut loose and reach a breakneck pace. There must certainly be many aspects of human nature from which this phenomenon originates. This same dynamic pace exists within traded securities, and it can be expressed through volatility. Many attempt to isolate it to a measurable cycle. While that may be possible, it need not be as complicated as waveform analytics. It's actually as simple as a signal from an extreme relationship. Let us be specific about the price scenario being described. Consider when a stock has been in a very flat trading range. Volatility as measured in a variety of ways contracts. The price action usually shows almost no cycling and is largely dominated by the average daily range. Then, price suddenly proceeds to trade strongly in a different direction. The average true range value expands, along with the overall trading range. This is a commonly observed occurrence. It happens visually to almost all stocks and across most time frames. It is important to note that the visual nature of the pattern does not coincide with the underlying mathematical relationships. Most often today the low volatility phase is detected by an extreme narrowing of Bollinger Bands. John Bollinger refers to this as a trading opportunity known as the squeeze method. What you will see presented in the following is detected differently and has a limited degree of overlap with a Bollinger Band squeeze. Perhaps a more useful fabric is one based on linear regression. Linear regression more closely tracks price movement. It is a better indicator of short-term central tendency. Also, average true range is a better measure of short-term volatility. Therefore, let us try a volatility fabric that is built on a 40-period continuous linear regression line. We see once again in figure 6.3 a daily chart of Motorola. But this time there is a linear regression volatility fabric on the chart. The fabric threads consist of average true range, ATR. The thread nearest to the center 40-period linear regression line is exactly 2 ATR, 14, values away. After the first thread, each one thereafter is one additional ATR, 14, value. Therefore, working from the inside out, the threads are at 2, 3, 4, and 5 EEATR, 14, amounts from the interior linear regression line. This author's preference is a linear regression volatility fabric for these reasons. There are fewer telescopic swings within the threads than with other measures. This is because its components are better measures of trader behavior. Expanding or contracting short-term volatility is generally obvious. Most price movement will be contained within 2 ATRs of deviation from the inner linear regression line. Most valid overbought and oversold levels are reached between 2 and 4 ATRs deviation. A value outside of 5 ATRs deviation indicates a very abnormal situation and should be looked at in a higher time frame. Short-term price movement across key thread levels can give valuable indications of short-term trend changes.